on the other side of US CPI data, and it does very little if we could consider the impact on Fed policy expectations. But stocks certainly like the stasis, nothing broken, and so they keep going higher. That gives us an entire week and a half now to consider what is going to happen next without too much big picture U.S. economic data before next week's Fed policy announcement. But we are going to turn our gaze elsewhere. And of course, we'll be back to talk about U.S. retail sales data and consumer confidence data as we continue this week. But the focus today taking us to China, because one of the standouts that we've really seen around the financial markets has been a very brisk recovery in Chinese stocks. In fact, February saw a gain of 9.3, 9.4%, but depending on whether you choose to round it or not, of course. And that was the largest increase for China's CSI 300 benchmark since November of 2022. And we've added another 2% or so already so far in March. So something seems to be afoot here for Chinese markets. And while we have a bit of a lull in U.S. news flow, what we'll do is take a look at what is going on in Chinese markets and really why there seems to have been this return to life and whether that has follow-through potential. Because, of course, Chinese markets have been a key underperformer. So if you're worried about chasing stocks in the US into the highs, chasing stocks in Europe even into the highs, one place where there seems to be plenty of room to keep going is in China, at least as far as where markets are relative to where they've been. The question now, of course, is will they actually keep rising? And so that's what we'll focus on here and see what comes next. Here is that benchmark CSI 300 index. This is a benchmark to think about sort of in the same way that you think about the S&P 500. It's a kind of catch-all for the biggest names on China's two main stock exchanges in Shanghai and Shenzhen. And it's this increase that we're looking at right here after the long slide all of last year. Now, that slide last year, of course, is notable because China began to reopen from zero COVID restrictions right here. And so the hope, obviously, was that after a very long decline going into reopening from COVID restrictions, you would have a big splash increase in performance. And needless to say, it did not happen that way. But there does seem to be a spirited advance here. This rise off the low is now in excess of 16%. So certainly not a shabby bounce. Now, of course, we've had bounces in this trend before that are more sizable. These here are about 20 to 22% apiece here and there before we resume the decline. So it's not as if we are looking at something that is unprecedented in its vigor for Chinese stocks here. 16%, it's still kind of well within the balance of what could be called normal. But nevertheless, we are looking at what is appearing to be an important recovery. Needless to say, we have had some recovering to do. If we look at the beginning of the rise in stock markets following the 2022 rate hike cycle, which essentially sank stock markets across the world, U.S. stocks were down for the year, European stocks were down for the year, really global shares were down for the year. We started to recover in the early part of October of 2022. And since then, we can see European stocks have outperformed. EZU here, the ETF that's tracking the Eurozone stocks index, the 50 top stocks from the region. It's up 58%, beating even the S&P. That's up about 44, 45%. Globally, the All Country World Index, and again, that's the ETF there, ACWI, up 40%. China, ASHR, the index that is tracking that CSI 300 benchmark, it's down 8.5% over the same period of time. Now, of course, it was down as much as 20% going into this year, but clearly it's managed to shave that down significantly. The key thing to look at here is if we look at emerging market stocks that include China, this is the MSCI Emerging Markets Index ETF, it's up less than 20%. If we exclude China, it's up more than 30, EMXC. So we're looking at a situation here where clearly China is the laggard. And we've discussed at length sort of the reasons for this. Most of all, of course, China has taken much longer to shed COVID restrictions than did its end demand markets in Europe and most especially in the US. That's meant that it's lost critical market share in global commerce, in its kind of role as the quintessential value add center for global supply chains, where raw materials and semi-finished goods come into China, are assembled, are finished, are more finished, and then move on to either end demand or the final kind of finishing stages of production. Really through the period, let's call it from the early 90s, pretty much up to the pandemic, China was the quintessential node for the global supply chain for that kind of value-added work to happen. It's lost a significant amount of it because it stayed on lockdown for as long as it did through the COVID pandemic. Not only, of course, because its end demand markets had to diversify supply chains, they reopened much earlier. Their peaks in growth happened in catch-up. Post-COVID growth happened much earlier, as early as the middle of 2021. And so, needless to say, this is why a lot of those economies have runaway inflation. It's that they've been dealing with, and in the case of the U.S., have been very successful in dealing with. But clearly, there had to be adjustments made to supply chains to shift them elsewhere. And then China's more assertive geopolitics over recent years have kind of spurred that on, encouraged it, and kept the changes that occurred largely intact without a shift back to China once it finally did reopen. And so there's clearly some permanent damage being done here, and that might explain, and seems to, why shares there have so thoroughly underperformed. But there do seem to be some genuine green shoots here. In fact, if we take a look at volumes that traverse the Hong Kong, Shenzhen, and the Shanghai Hong Kong stock exchanges, this is the linkage that allows people with access to mainland exchanges to trade directly in Hong Kong, and so to have an out into global markets that way, and also for people that have access to the Hong Kong exchange to trade directly on mainland exchanges, and so to have access from global markets into the Chinese mainland directly. We can see that we're still within the range of values here, but there's clearly been a sharp pickup in turnover. You can see it right here. Now, of course, we've seen some peaks here that even in the initial kind of reopening give us a higher high, and even during the lockdowns give us a little bit of a higher high. But this was very clearly listless all of last year and has stopped being so now. So there does seem to be a genuine pickup in money moving back and forth and some genuine activity occurring. There is some genuine economic backbone to this. If we look at what's going on with the pace of economic activity, we can see that the speed of contraction in manufacturing seems to have anchored. These are, of course, PMI readings, so as ever, they're centered around 50 right here, which is neither growth nor contraction. We can see manufacturing still below 50, and so in contraction mode, but services has had a meaningful uptick over the past several months. And at this stage is giving us the fastest expansion for that sector in 5 months. So there does appear to be some genuine picking up of economic activity that's behind some of what we're seeing in the stock market. If we look at that value-added work that we were just talking about and the pain that has come from losing that work, we can see over the past 3 months some notable improvement in cars, in integrated circuits, in smartphone manufacture. And so it does look like there is a bit more uptake that's occurring. It does look like there's a bit more of a hopeful view on maybe there is some reacceleration in China's external sector, which of course is quintessentially important and really the main kind of wound of COVID. So perhaps there is, in fact, something to be optimistic about. As a matter of fact, we can see that after quite a protracted decline, both imports and exports are trying to return to growth. In fact, seeing that happen for imports is perhaps most interesting. We haven't seen that since October of 2022, really. But imports are finally in positive territory, which would suggest that maybe we are getting to a place where domestic demand is getting a little bit better. Exports seem to have picked up since the beginning of last year. So there does appear to be, again, something of a normalizing dynamic that's very cautiously occurring. We talked a lot, and there's been, needless to say, buckets upon buckets of ink spilled on China's housing market. So much domestic demand hinges on the housing market because it is far and away the vehicle for savings and investment for the population. So if housing prices fall, then people don't spend as much because the wealth effect is tremendous. They feel like their savings are being rapidly eaten away. And of course, much of Chinese growth over especially the past, let's call it 5-10 years, has been driven by brisk borrowing to build up infrastructure, to build up cities, to build up residential property. And so that, of course, juices employment, juices wages, and then juices consumption. So tons has been said about the problems with the collapsing housing market because, of course, as we get this kind of overhang from COVID, you likewise get weakness. People start to sell. People start to try to free up cash because work is not as briskly had. And although we still have overall falling housing prices in China. You can see there's zero. This is the year-on-year rate for prices. They do seem to be anchoring a bit. It does seem like whereas we had significant declines, let's call it late 2022 going into 2023, it does look like we're sort of anchoring near zero. So we're not necessarily growing. We're still, in fact, in negative territory, but the magnitude of decline has significantly slowed. The deceleration has been much more aggressive and now appears to be finding something like a bottom. So perhaps, again, some early signs that things are getting a bit better. Having said that, over extrapolating on all of this is probably a dangerous exercise. And data that we have coming up this week is set to highlight exactly that. We already had a piece of very sobering news this week showing that vehicle sales, despite that increase in value add, fell a whopping 20% in February. Now, in fairness, they also grew 48% year on year in the prior month. So large swings here are not out of scope, to be sure. But nevertheless, if we look at what this implies as far as individual units sold, we are now down to the lowest number, about 1.6 million, since April or so of 2022. So it's not as if we have tremendously good news here for overall vehicle sales, despite the fact that the decline is only large when we look at the number, not necessarily when we consider the series of numbers. Later this week, we're going to get loans data with expectations that there is a slowdown from about 4.9 trillion yuan to just 1.5. Overall financing, so not just new loans, but total loans outstanding, new and existing, expected to come down from 6.5 trillion to 2.2 trillion yuan. So again, significant downswing here. Outstanding loan growth seen slowing from 10.4 to 10.2%. And then as we look at numbers that are going to be out over the weekend, essentially, for the U.S. and early Monday for China going into next week, a slowdown in industrial production, a slowdown in retail sales, a slowdown in capital investment is not on the table. Capital investment seen increasing a little bit, but only a little bit indeed. Whereas the drops in retail sales and in industrial production look much more outsized. Now, if we look at Citigroup's index of economic surprises and see how data has performed relative to forecasts, we can see that we're basically pinned at the zero level here, which means that economists' models are fairly good at this point at reflecting the reality on the ground. So we might expect that these numbers are going to come out somewhere pretty closely in line with expectations. And that, of course, suggests that maybe this isn't the time to scream about all the progress being made, because the issues that the Chinese economy faces continue. Here is new loans. And indeed, if we look at the cumulative numbers, new loans are significantly rising. But if we look at the growth rate, this is hardly encouraging. We're basically near what is an average of zero loan growth. And although we've seen spikes here and there, right now we're barely growing at all. Overall social financing, similar story. To be sure, there's individual spikes, but year on year, we're declining. The growth rate in credit is actually a pittance at most. In fact, if we look at the Bloomberg Credit Impulse Index, which essentially just measures new loans as a share of GDP, we can see that we've basically flatlined from up the bottom in around the latter half of 2021 or so. This, of course, is the big COVID collapse in lending. Over here, we have essentially stasis. And so we're not really in a position here, it would seem, to say that, for example, Chinese stimulus is working especially well, because it doesn't look like there's any meaningful pop in credit utilization in the interest of economic growth. And perhaps most critically, the pricing structure in the economy suggests that demand is still woefully inadequate. Here's the CPI and PPI readings that we've most recently seen. And we can see that although CPI has narrowly returned into positive territory, it's still just a hair above zero, whereas PPI is still deeply in negative territory. Now, when the price of things is falling, that's generally indicative of absent demand. When there's lots of demand, the price rises because, of course, people compete to buy whatever limited supply of goods that there is at the margin. And when there is robust demand, that competition bids up the price of stuff. When, on the other hand, stuff goes on discount, it is to clear inventories because nobody's buying. And so, since we've had months and months of falling inflation here, absent the most recent pop in CPI, the message that we're looking at is there isn't a significant amount of domestic demand, to put it lightly. As a matter of fact, if we take a look at a very broad-based economy-wide measure, what we find is that in China still, for the past 3 quarters running, nominal GDP is actually growing slower than real GDP, which is not really the way that that's supposed to work. Real GDP is nominal minus inflation. If real is above nominal, then the inflation you're subtracting is negative. And that's what you're seeing right here. There is the sense that there is a deflationary gap in Chinese GDP growth to the tune of almost 1.5% of the size of the world's second largest economy. So, although it is certainly encouraging that Chinese stocks are popping, and there are certainly some signs that we're off the worst of the pain, the data that's coming in here might well remind us that it is far from all clear for China's economy. And so this bounce in Chinese shares may well run into a wall before very long. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what is likely to happen thereafter. Back on with Chris for Futures Power Hour on Fridays, on with Tom and Victor for First Call on Sundays, writing for the news and insights portion of tastylive.com, and opining on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. See you tomorrow.